Welcome to Commercial Real Estate Pro Network's CRE PN Radio. Thanks for joining us. My name is J. Darren Gross. This is the podcast focused on commercial real estate investment and risk management strategies. Weekly, we have conversations with commercial real estate investors and professionals who provide their experience and insight to help you grow your real estate portfolio. Today, my guest is Ken Gee. Ken is a CPA and real estate broker. He's also the founder and president of the KRI Group of Companies, which he started in 1997 with a purchase of a 28-unit apartment building in Cleveland, Ohio. Since the beginning, KRI has evolved into a full-service real estate company that specializes in multifamily apartment investment, syndication, and property management services. KRI has owned more than $55 million worth of multifamily properties and managed over 15,000 apartment units, collectively worth more than $1 billion. And in just a minute, we're going to speak with Ken about how to consistently make money in real estate. But first, a quick reminder, if you like our show, CREPN Radio, there are a couple things you can do to help us out. You can like, share, and subscribe. And as always, we encourage you to leave a comment. We love to hear from our listeners. Also, if you'd like to see how handsome our guests are, be sure to check out our YouTube channel, and you can find us on YouTube at Commercial Real Estate Pro Network. And while you're there, please subscribe. With that, I want to welcome my guest, Ken. Welcome to CREPN Radio.
Thanks so much for having me.
I'm really looking forward to our conversation today. But before we get started, if you could take just a minute and share with the listeners a little bit about your background.
Sure. Grew up in Toledo, Ohio. Came to Cleveland in the early 90s, where I started. I came to Cleveland to be a commercial lender. Spent 5 years there. Transitioned my life then to be a CPA. Went to work for Deloitte for 7 years. And then decided that was working way too hard for everybody else, and decided that I needed to get into real estate. When I was at the bank, all I heard was my customers making tons of money in real estate. Then when I went to Deloitte, all I saw was a massive real estate tax practice in our local office. And I said, you know what, I've got to get into this. So that really was what started this whole process. And like you said, I bought my first property, 28-unit building in Shaker Square, which is in Cleveland, Ohio. And then been going ever since.
Oh, that's awesome. Well, and I'm guessing you've seen just a few things since that first property that you bought. I'm kind of curious, what do you remember most about that first deal?
Yeah, what I remember the most about that first deal was the golf ball that was stuck in my throat when I was doing the deal, because it was a huge mortgage. At the time, it was $460,000. That was massive. At the time, I couldn't have paid that mortgage off to save my life. So what I was doing was risking really everything to get started in this business. And it was stressful, even though I'd worked really hard to try to understand the business, try to make sure I knew what I was doing. At the time, I was a CPA and I had some lending background. So, I felt fairly well informed, but it doesn't change the fact that you're not ready for that stress that you get when you sign on that loan. So, I'm happy to say that, it went away very quickly right after that deal closed. And every new deal that you do, there's stresses associated with every deal, but, it's been far easier since then. And that's why I always tell everybody, get over that first deal, because that first deal is a big one. And you're going to deal with emotions that you didn't expect. And once that's over, it becomes a lot easier.
No, that's well put. The first deal, did you do it solo, or did you syndicate or have investors in the first one?
Yeah, no, great question. So I actually borrowed half of the down payment on my home equity line of credit, and I invited a family member in to do the other half. So we kept it in the family, because at the time, I couldn't with a conscience ask somebody that I didn't know to invest money with me, because I really hadn't proven myself yet. So my family was willing to take a risk on me, and I'm thankful that they did, because that's how we got started.
And how long did you keep the property?
Actually, 3 years.
3 years?
3 years. Yep.
And in 3 years, how did the property returns on that first deal?
Yeah, interesting little story about a couple months in to that deal. I was getting everybody that applied for the apartment didn't have good credit. And I thought, oh boy, here we go. This isn't going to be good because I need someone to pay the rent. And then I met this wonderful woman from the city of Shaker Heights. Her name's Karen. I won't say her last name, but she taught me that, Ken, if you will make your property nicer, if you will invest in your unit and make it really nice, you'll be able to collect more rent. And guess what? The good people will come. And I asked her, I remember vividly this conversation. I said, well, Karen, how much do I need to spend on this unit? She said, oh, only about $5,000. Well, the lump came back in my throat. I said, are you kidding me? $5,000? Where am I going to get $5,000? I just spent all my money to buy the property. So I took the leap of faith. I did spend the $5,000. And sure enough, that rent that I was at $479, I went to $599 because now I had a much nicer unit. And all of a sudden the applications came from really good people. And I thought, oh my goodness, this is unbelievable. That was a huge deal for me. And the introduction of the value add concept to me, I owe really a good chunk of my career to that wonderful woman who told me to build it, and they will come, because she was right.
No, I love that. The kind of the experience of you just spent all your money I mean, did you have any kind of a plan as far as renovation, or is it more about just lease it, keep the place leased up based on the
Well,
numbers?
I was pretty naive back then. I thought I was just going to buy it, hold it for a while, rent would slowly go up, and I would make money. And I actually paid an attorney to sort of advise me. And he thought, you know what, Ken, in 3 or 5 years, you're probably going to make $100,000 on this. And I thought, oh my goodness, that's unbelievable. Did I have the same level of business plan that I would have now? No, absolutely not. I didn't, because I didn't even understand. There was a lot I didn't understand. So she actually helped me create that business plan on the fly. And we've been really implementing that value add concept ever since. And so 3 years later, I'm happy to say that we sold it. We each put in 35,000. We each got back 100. So, in my life at that time, making that kind of money was just obscene. This was just unbelievable that you could do that in 3 years. So that's why I'm here. That's why I continued on with the process.
No, I mean, those returns are impressive anytime. I think, if you can triple your money in, 3 years, that's or just about right. 30, 35,
It was, yeah.
100.
Yep.
Yeah. So,
Mm-hmm. Yep.
I think those are respectable. I think today they'd be world class. So that's great. So your first deal goes well. Did you do any additional deals during the first 3 years, or was that kind of your primary focus? Get that one up and running. You sell. When did you do your next deal?
Yeah, that's a good question. The second deal, it took me a little bit of time. So I did 3 deals, a total of 3 deals during that 3-year period. The second one came shortly after I got my education from Karen, and I did have a plan the second time. And I had my value add plan. I was going to go in, improve the units. The lender would advance some funds to help me do that, as long as I showed them that I did the work, got the lease rents that I promised them that I would get. They would then pay for the renovations. So that was deal number 2. And then deal number 3 was just a great, wonderful building in that same area. All these properties were in the same area that I bought, and we all ended up selling them all at the same time. So yeah, I kept trudging forward then and just doing deal after deal after deal, because once in this business, once you feel that success, you want it again. I mean, who wouldn't want to make that kind of money, right? So you're going to try to do it again and again and again. So.
Got it. So your first deal you did with family, the second and third, were those also family, or did you reach out beyond your?
Yeah, the second and third deal actually was able to do with myself, by myself.
Okay.
Yep.
Okay.
I found creative ways to finance it. If you look back at our track record is actually out on veravest.com. They verified our track record, but so it's there for everybody to see. Those early deals that we did were very highly leveraged, so the returns were just crazy. We don't use that level of leverage now because we use other people's money, and there's lots of reasons why we wouldn't do that. But when you're getting started, you do whatever you have to do to get started. That's what's important.
Right, right. So, well, that's impressive. So the first deal you did have a partner. The second and third you were able to do on your own. Um, at what point did you become more of a syndicator? Start raising capital.
Yeah, good question. So probably in I think we syndicated our first deal in the mid 2000s, early to mid 2000s, and um, and grew slowly during that time. And most of our syndication work has been done really in central and northern Florida. So the company originally grew up in Ohio. We did a bunch of deals in Ohio, and then 10 or 15 years ago, I wanted to go to a growth market. So we started investigating Florida, central and northern Florida. And those were, I think we've syndicated now 3 or 4 deals there. I can't recall now. And we currently have a fund that we just finished raising for about $13 million, and we're out now trying to deploy that capital. So we did for a period of time between 2000 and actually it must have been 2004. We did some deals on our own with one other partner, and then we really went full boat into the syndication world, because what we learned was once we felt like we knew what we were doing, we felt comfortable inviting other people into our deal. And then that allowed us to grow even quicker and allowed us to give them, pretty good returns as well. So that's why we made that transition. And it just made sense. And it's been going well ever since.
Gotcha. So you mentioned, having confidence, or I guess a proven track record, something that you felt that you could then, uh, I guess, provide a story or proof of concept to potential investors and stuff. What were some of the keys in that story? I mean, the first one sounds like you're flying blind, but you learned the value add concept,
Yep.
and some other keys to creative financing for the next couple of deals. What were some of the key takeaways that you learned that were uh, you know purposeful or helped with uh, relaying your story to investors?
Sure. So what happens as you gain more and more experience in this business, you start to understand exactly what makes real estate investors successful over the long term, right? So a lot of people can do this maybe once, maybe twice, but if you're going to do this over and over and over again, you really need to understand why each deal is successful. So, I generally, there's 4 things that you really got to understand. One is just supply and demand, right? We're in the apartment world. So the supply of inventory is important, right? If they're building like crazy in the area that you're trying to invest in, you need to be careful. You have to make sure there's enough demand to absorb that. So what we're looking for is a favorable demand and supply equation. We want demand to exceed supply. That's what drove us to Florida, because that setup has been in Florida for years and years, decades now, and it's only been exaggerated by the pandemic. Then the second thing we understood is, how do we create value in every deal? Because every deal is going to be a little different. Sometimes most of the value you create is going to be management related. Sometimes it's going to be physical improvement related, but or most of the time it's a combination of the two. But what we learned over the years was you got to understand exactly how you're going to create value, and then just get better at executing on that strategy. So that was the second thing that is the second thing that I think sets long-term successful investors apart from shorter-term ones. Now, the third thing, and this was really learned the most through 07, 08, 09, 10, think back to that financial recession. I mean, that was horrible. And the number one thing you learned through that process is to manage your debt, manage your maturities, make sure that you have planned for as much as possible, right? Apartments generally did well during that time period. The only reason apartments didn't do well is when the loan matured at the wrong time. And then it didn't matter if the property was a wonderful property. It didn't matter if it was cash flowing like crazy. The bank had to get it off their books. And at the time, no one was doing no new loans. So people lost their buildings because their debt just happened to have matured at the wrong time. It was terrible. There was no reason for that to happen. But again, what that does is that teaches us to manage your maturities, make sure you have an out, make sure you have a way to continue that debt should you need to, just because of a bad timing issue. You don't want to have a problem. And then the last thing we learned, we have learned over the years, is to just watch cap rates. You got to understand cap rates. And, cap rates are fairly predictable. They're dependent on two things. One, the interest rates on the debt that you're going to get. So we always watch that and have a pretty good feel for where we think they're going to go. And then the other piece of that cap rate is what investors require for their return. And so that right now, cap rates are compressed because there's so much money chasing deals right now that investors are willing to accept smaller and smaller returns. So when we have low interest rates, low investor return requirements, we have relatively low cap rates. So when we do our modeling, this is the long-term successful investor concept, you need to make sure that you're planning your exit at a higher cap rate, because that means the value might go down. If interest rates go up or not as many investors are chasing the same deals, they may not be willing to pay as much for that cash flow that that property creates. So you're going to want to make sure that you model it in your formula so that you're prepared for that and you know what's going to happen if cap rates were to move against you. Does that make sense?
Yeah, no, all of that makes sense. And it is, especially looking back here in just the last 10 years, you can kind of tell, the story. If you look back, you can see how it all, connects. I mean, from, like you said, 07, 08, when the market was melting down and nobody was willing to lend. And if you did get caught and had to refinance, and there was nobody willing to lend, that's kind of what created a lot of the opportunity for newer investors, or I mean, clearly it was a problem if you had a property that you needed to refinance. It was an opportunity if you had cash and had an opportunity to pick up a property cheap from a lender that, or not necessarily a lender if you weren't foreclosed, but just somebody that had to let go of a property, kind of thing.
Yeah, exactly.
But even having said that, though, what's interesting to me is I've been doing this podcast here for I guess almost 6 years now, and in all the time that I've been doing this, the theme has been that hey, it's been a good run. We're probably in the late innings. We expect this thing to have a correction, kind of thing. But I'd say that by all accounts, we're well into a double header, or with extra innings. I mean, just based on the run, and it's. I think the other thing is that all of these economic factors that maybe were the cause, or had something to do with the last cycle. Everything we're looking at right now, pandemic, lots of government cash being pumped into the system, investors looking for a return, low interest rates, all kind of change anything that people thought might be the case. And now it's kind of like really, it really requires you to be sharp and kind of assess, like you were talking about, supply and demand, how to manage your debt, make sure you have some terms that can last a while, and kind of keep an eye on those cap rates. I mean, that's pretty well, that right there, I mean, I think sums up, a good advice for any investor looking at an opportunity, and certainly in these last 6 or 7 years.
Yeah, no, I agree 100%. Absolutely. And when we look, I have this conversation with a lot of people all the time, and that is, are you afraid we're at the top? Or are you afraid you're at the top? And I have it with a lot of very smart people, because I'm looking for some disagreement. And we're in Central and Northern Florida. The demand supply setup in Central and Northern Florida has been favorable for a very, very, very long time. And I'm looking, one of those two things has to break in order for me to be really concerned about Florida. We have to have builders somehow figure out how to buy BC class asset, because that's what we buy, right? We don't buy the brand new A stuff, because then I'm fighting with supply from new builders, right? So they're not building BC stuff. They're just not. So I don't see that changing. I don't see what can happen that can make that affordable for builders to come in and add tons of supply to the BC market. So now when I look at the demand side, what can happen that can erode that demand? And and I think about why people are moving to Florida. I mean, they move there because it's beautiful weather. They move there because it's a low tax state. They move there now because they can live there and still do their jobs, because so many more people can work remotely. So I'm looking for something to break that demand in order for me to be terribly concerned about investing in Central and Northern Florida. There's still plenty of places that are very affordable in Central and Northern Florida, and that people are going to continue to move to those areas. The coast will continue to get bid up, I think, and the growth has been between Tampa and Orlando and Daytona. It's been going across that I-4 corridor for years, and it'll just continue to do that. And when it gets too unaffordable in one area, say Orlando, for example, you just get farther away from Orlando and you can find more affordable housing, more people come. You see, it's a cycle, and I don't see it breaking. So that there are probably some markets that demand supply setup is different. And if there is an economic slowdown or something changes, that might affect them more. But I'm looking for those two things to change in Florida, and I just don't see it happening. But I have my eyes definitely open, looking for any cracks in the dam here to see if that is going to happen, and I just don't see it yet. And everybody I talk to, they're looking for the same thing, and they don't see it either. So that's why we're comfortable buying at this point, as long as we have the upside in rents, which we do because of the demand supply situation.
Right. No, and even, the kind of that lesson you learned from Karen about value add. I mean, if you can find that opportunity that either the seller hasn't exercised or hasn't, doesn't see that you can see, there's always the opportunity to increase the value. And I think one of the things I've learned is that it's, while you can do it through the, a remodel or renovation or something like that, if it's only just a management issue where you can raise rents or something like that, I mean, that's a pretty sweet little value add opportunity there. Do you, in that marketplace, I mean, it's clearly no secret, Florida is kind of a boom market. I mean, I saw the meme out there that Andrew Cuomo was realtor of the year for Florida. That was kind of the joke there from all the all the people exiting New York, moving to Florida.
Right.
And but a lot of truth to that, just based on like what you were saying, just demand. Mm-hmm. And so as you look in that market, clearly there's lots of demand for housing. There's mm-hmm. lots of investors seeking the same opportunities. One of the things you didn't say, but I always feel it kind of is part of that cap rate is if there's a lot of investors seeking the same thing, that's going to push the rate mm-hmm. Cap rate down as well. How do you go about it? Are you just plugged in with the market? Do you go direct to the sellers? Do you have broker relationships? How are you situated where you find your properties?
Yeah, that's a really good question. So we play in generally the plus or minus 100 unit range. And most people that play in that market, in that space, are syndicators. So that means they're going to go out and try to get the deal locked up. And then they're going to spend the next 45 or 60 days trying to raise the money to close the deal. So the seller kind of takes a leap of faith with that buyer. So there's tons and tons of syndicators in that space. Now, we are a fund. We're a private equity fund. So now in the syndication world, the deal comes and then the equity comes. In the fund world, the money comes first, then we have the money to go get the deal. So now when I compete against a syndicator in that 100 unit property, when we compete, there's probably 98% of the bidders are syndicators. And here we come, we're a fund. We already have the equity raised. The seller knows that that equity raise risk is off the table. They know, so they also know that we're very experienced. They also know that we have a very quick and easy due diligence process that because we've been doing it for 25 years, right? We're not going to drive him nuts or her nuts with a retrade or, little silly asks on due diligence questions and things like that, because sellers do like easy deals. So we're a much more experienced, much stronger buyer in that market. Most fund managers, they don't attack the 100 unit space. They're up into 300-400 unit spaces because they're trying to deploy more capital. So we become that big fish in the smaller pond, so to speak, which gives us the ability to win these deals. And then remember, we talked about the fact that we're third-party managers. So we're third-party managers in that same market. So that gives us another opportunity to integrate with these brokers because they refer their clients to us. So we have a very unique relationship with the broker community in that not only do we buy and sell through them, but we also help them get deals done because we take their clients, run their properties, make them more successful. And then what happens? They're able to sell that client another property. So we have this really intertwined network that we've been able to develop in the central and northern Florida market. So that's how we get our deals, because the reality of it is, in a competitive market like this, the broker really controls who gets the deal. Because when a seller sells that property, he looks to the broker and asks him, who is this guy? Who is this guy? Who is this guy? What do you know with them? Have you closed with them before? He is using that broker to try to figure out who has the highest certainty of close and who's going to really get the deal done so that that seller has an easy sale. And that's critical. And that's why we spend so much time working on those relationships. Really, really super important in a competitive market like this.
No, I was going to say, I think having the property management company for yourself and others makes a ton of sense. I mean, just because the operations of a complex really, having efficiencies in the operations can really, make yourself quite a bit more money, I would think, as opposed to unaccounted for or expenses that aren't always easy to keep up with or whatever. Just having that I guess inside track on the management. I think that makes a lot of sense. Have you had any opportunities come from the properties you've managed where seller or the owner has said, "Hey, Ken, we're ready to get out of this one." Has that ever come up?
Yeah, we have those discussions, or our clients come to us occasionally with those discussions. And if you're a seller, what I tell our clients, because remember, when you become our client, we have this fiduciary relationship with you, right? I'm your guy, right? So if you come to me for advice, I'm going to tell you what you really should do. And the reality of selling in a competitive market is you should market the property. If you do a side deal with me, that's great for me. But I get very, very concerned that my client is going to have in the back of his or her mind, he kind of worked me for a sweet deal here. And they kind of get, at some point, I run the risk that they're going to be uncomfortable with the advice that I gave them. And that was to sell to your friend Ken, right? I get concerned with that. So our reputation in all the markets are so important to us that I don't even want to take that risk that something could later develop, even though it would get a deal done for them, but it would get a deal done for us. But I don't want them to think that I got a better deal because I was able to get to them early.
Gotcha. Well, I think especially if you want to maintain that relationship with the brokers, I would think that would be wise to not bite the hand that feeds you, kind of thing there. So.
That's true too. Yeah, I didn't talk about that, but you're correct. But the real driving force here, when my clients and I have these discussions, is I always want to tell them what's right for them. Right. Irrespective of my allegiance to brokers or to anyone else, my first allegiance is to them. And I want to make sure that no matter what, I mean, we go to our clients and say, you know what, you have worked this thing. We have done a great job. You need to sell this thing. We'll go to our clients and tell them that because, we know the market, we understand, right? We know what's going on. So, that's the real driving force. It's not protecting the broker relationship, although that's important. It's more important that we treat our clients properly.
No, makes sense. So how many deals have you syndicated over the course of your investing career?
Yeah, that's a good question. Let me do the math in my mind. Probably 6, 7, 8, something like that. We have a deal in process right now with our fund that we just raised. we accept to get 3 deals out of that fund. That's the goal.
Gotcha. And of those funds, have all of those gone full cycle, or not the funds, but the syndications? Have all of
Yeah,
those
all but
gone full?
one. All
Okay.
but one. Yeah. So we have not historically been a unit. Some people get in this business to buy unit count, right? To get as many units as you can, because I guess it's you have bragging rights then, right? So we don't do that. We because of our investors, we want to add our value. We want to leave some for the next guy, and then we want to go ahead and sell that asset, because then it's gone full cycle. There's no way to argue with any valuation. I mean, investor went in, investor got paid, investor's done, the whole deal's done, and you know exactly how much you made on it. So we're down to 1, soon to have 2, and 2 more after that, I'm sure. We're working on a number of deals right now.
Gotcha. Well, it's impressive, the number of deals you've done and lessons you've learned, and the fact that you've now got a fund. That's and for the reasons that you did, as far as the opportunities that are going to, or just how you'll be viewed, in the market, as opposed to a syndicator that's got to go out and raise the capital there. I think that's a pretty unique and good way to put yourself in a competitive market, is the capital's already been raised.
Right.
So that's good. Hey, Ken, if we could, I'd like to shift gears here for a second. As I mentioned before we started recording, by day, I'm an insurance broker, and I work with my clients to assess risk and determine what to do with the risk. And there's 3 strategies we typically look at. We first look to see if we can avoid the risk. If that's not possible, we look to see what we can do to minimize the risk. And when neither of those are an option, then we look to see if we can transfer the risk. And that's what an insurance policy is. It's a risk transfer vehicle. And as such, I like to ask my guests if they can look at their own situation. It could be their clients, the market, capital raising, however you would like to frame the question and the answer. But looking to see if you can identify what the biggest risk is. And for clarification, while I am an insurance broker, I'm not necessarily looking for an insurance related answer.
Sure.
So if you're willing, I'd like to ask you, Ken Gee, what is the biggest risk?
Sure. The biggest risk right now, as I see it in the market, is it's very difficult to find deals that will work. And the reason I call that a risk is, if we're not able to make the deal work and someone else does the deal, it probably won't work for them either. So the risk here is that people will do deals that they really shouldn't do just to get the deal, right? If you've ever heard of FOMO, fear of missing out, there is a lot of that going on. And if we do lose a deal, it's probably because someone else was concerned about missing out. They're willing to pay more to make deals that didn't make sense, A, because maybe they're inexperienced, or B, they just want to get in the game because they're dying to get in the game. So that's the biggest risk. That's a risk to me, but I think that's a risk to the entire industry, because when people do things that they shouldn't do, you need to hope you're in a growth market that's going to grow fast enough to allow you to grow out of your mistakes. And if you're not, then you're going to get stuck with them, and it's going to impact the market. So that's the biggest risk. Now, having said that, the number one reason we do multifamily is because I can't find a better risk adjusted return profile. Everybody needs a place to live. They just do. I can't figure out a way to make that go away. I can figure out how to not need an office. I can figure out how to not need storage. I can figure out how to maybe not need medical, right? Think about all the different real estate asset classes, retail strip centers. I can figure out a way for that demand to really significantly decline. But what I can't figure out is a way for you to not need a place to live. So as long as I have that, I view that as a relatively low risk asset. And then if we're able to take that asset and produce 15, 25, 35% plus annual returns for our investors, I see that. I look at risk very similar to the way you do. I shouldn't be able to get those returns with this level of risk, but because we're good at what we do, and because it's real estate and it's leveraged appropriately, we really are able to get significant returns. So the number one risk, back to your question is people doing deals that they shouldn't do, because it's going to hurt the entire industry as a whole eventually.
No, I think that's something there's been certainly a weighted breath, waiting to see, where the correction's coming. So I think it's inevitable, but as long as there's, lots of cheap money and, willing investors, willing buyers, I guess, sellers are going to take advantage of that. So we'll see what happens. But Ken, where can listeners go if they would like to learn more or connect with you?
Sure. So one of the things I wrote a list a little while ago now. It's a small ebook. It's called Multifamily Real Estate. It's a total game changer. If you go to our website, kripartners.com/ebook, you can download this ebook. I'll tell you why I wrote it. I wrote it for two reasons. It basically has two parts. The first part addresses the number one question that everybody has to ask themselves before they get into real estate. And that is, how do they know people are making a ton of money in real estate? They're just trying to figure out how they get their piece, right? Should they buy a single family, a double? Should they buy an apartment building? Should they go into self-storage? Should they even do it at all? Should they invest passively with somebody like us, right? So I help them through that process, because it is a question that absolutely everyone who gets into this business faces. And I've seen it for 25 years. I've seen people wrestle with this. They just don't know how it fits into their life. And so hopefully the first part of the book helps the reader through that process. The second part addresses so when I go through that analysis, most people really should be passive investors, because they have wonderful full-time jobs. They make a lot of money, they do their thing, and they should truly just invest passively in real estate. Well, now the question becomes, how do you vet the real estate people out there that you can invest with? How do you vet a fund sponsor? How do you vet a syndicator? How do you know that their fund or their investment objectives match up with yours and the risk tolerance that you're comfortable with? So I take you through that process. I give you some insight into how our business really works. What makes a syndicator tick? Why do they do what they do, and all of that stuff? Help you understand the way the business works, because then, and I also give you some questions to ask, right? To just, how do you vet those sponsors? Because I feel very compelled to help you, the investor, make a good decision about who you invest with. Because if you do, you're going to be successful and you're going to keep coming back. And that's what we really want for this whole process, is for everybody to be successful, because there's no reason for anybody to fail in this business that we have. So that the ebook is kripartners.com/ebook, and download it's free. And, hopefully it is beneficial to whoever reads it. So that's how you can reach us.
Awesome. Well, Ken, I can't say thanks enough for taking the time today. I've enjoyed our talk, learned a lot, and look forward to doing it again soon.
Well, thank you for having me.
You bet. For our listeners, if you like this episode, don't forget to like, share, and subscribe. Remember, the more you know, the more you grow. That's all we've got this week. Until next time, thanks for listening to Commercial Real Estate Pro Network's CRE PN Radio.